Okay, guys, so now we've had a look at the break-even inflation rates to have an idea as to how the markets are predicting inflation. What we need to do is have a look at the bond yields that are being paid on government debt, because this is going to have another big impact on the currency markets. Because when governments in the Pacific country are not taking in enough tax revenue compared to how much they have to spend to run the economy, a government is going to have to borrow the difference from investors. And what they do is they are basically issuing a bond, which is an IOU. So they're basically asking an investor to lend their money, the government, and the government is going to borrow that money off an investor, give that investor back a specific amount of interest over a certain period of time until the maturity of that bond expires, and then the investor gets all of their principal back plus the amount of interest they've accumulated over that period of time. So let me just break this down for you, and we'll run through how this affects the currency markets. So a bond, as I said, is an IOU. The government's borrowing money because they're not taking enough money from tax revenue. And the yield is just another terminology used for interest paid on the bond. So a bond yield is simply the interest paid on a government bond per year. So markets mainly focus on the 10-year government bond. This is like the benchmark treasury that the markets look at, because mortgage rates are really pinned to 10-year bond yields. A lot of debt in an economy that banks issue, they use a 10-year government bond yield as the lending rate to set their personal lending on. So commercial banks, I'm talking about, for an example. So as I was saying, let's say the government does not take enough tax revenue to cover all total spending. They're obviously going to have to borrow the difference from investors. So for an example, let's say the US government spends $2 trillion to run their economy, or their country, but they only take in $1.8 trillion in taxes. So the government has to borrow $200 billion from investors because it costs $2 trillion to run the economy, but they're only taking in $1.8 trillion. So they have to borrow that $200 billion difference so they can afford to run their economy. Now, they issue bonds, which I said, guys, is an IOU, which basically means they have been a promise to repay the money that the investor is borrowing the government, and the principal that they're being borrowed, they're going to pay a certain amount of interest on that principal over the lifetime of that bond per year. And the interest they're being paid is a fixed rate of interest at the date the bond is issued. So here is an example of how this works. So let's say the government wants to borrow $10,000 from an investor. So an investor can buy a 10-year government bond and borrow the US government $10,000. Now, the interest rate at the date of the sale of the bond, let's say this interest rate is 0.91% at the time when the investor will borrow this $10,000 to the US government, and the US government sold that bond to the investor. Now, 0.91% of the $10,000 is $91 per year. Now, this $91 per year that the investor is going to be paid is a fixed rate of interest. So this amount they're being paid is basically never going to change once the investor buys this bond off the government. So when an investor is borrowing money, whatever the interest rate is at that time, that's how much interest that investor is going to get paid during the lifetime of the bond. And over this period here, if it is the 10-year government bond, so they're going to get paid this amount of interest on this amount of money every year for the next 10 years, as long as they hold that bond until maturity. Now, let's say, for an example, inflation rises, the expectations for inflation rises from, let's say 1.98% when they first bought the bond, and then it jumps to 2.68% in 4 months. And we saw that happen in the United States from the beginning of the year until May, for an example, right? So what do? If you're a bond holder, so you've bought this bond, you're getting 0.91% interest. Now the interest rate has shot up. The inflation rate has shot up to 2.68%. You're only getting paid 0.91% on that $10,000. So clearly, if you continue to hold this bond and only get $91 per year on your $10,000 investment, inflation is going to eat up that money, and you're not actually going to be holding the purchasing power of the money you're getting paid back from that bond, because you're only going to get 0.91% interest on that money, but inflation at 2.68%, so much higher than the amount of interest you're getting paid. So if you're a bond holder, you don't really want to hold this bond anymore, because what's the point in holding something that's not paying you enough interest to protect you from inflation? There's no point. You're now losing money every year to inflation. It just defeats the purpose of buying a bond to try to make a profit on your money above the rate of inflation, to make sure that your money that you're investing keeps its purchasing power so you don't become poorer due to inflation. That's the problem that bondholders have when inflation jumps after they purchase a bond. So obviously the bondholder is going to think, well, I'm going to sell my bond. I don't want my bond anymore because I'm losing money on it. Let me sell it to somebody else who will buy this bond off me. So when you buy a bond of the government, you could then freely trade bonds on a secondary market. So this is where people who own bonds can buy and sell bonds of other bondholders or to the general public. Anyone else who wants to buy a bond from you can buy it, or if you want to buy a bond from someone else, you can go into the secondary market and you can buy the bond. So the bond's price then fluctuates in this secondary market based on either a new supply of bonds or the demand for bonds going up or down in the marketplace. So let's say investors don't want to hold this bond anymore, and now the demand for bonds is going lower. So investors start to sell these bonds, and let's say the bond price drops from $10,000 now to $5,000 because so many people are selling the bond that people don't want them, so the price drops down to $5,000. Now that 0.91%, which was $91 you was getting paid when you first purchased the bond, about $91 is now 1.82% of 5,000, the value of the bond now. So you can clearly see that when the bond price drops, the interest rate rises. Clearly you can see that, because when you purchased the bond at first, just remember I'm saying he was getting 0.91% of that 10,000 was $91 per year. But now 0.91% of $5,000 is now 1.82%. So you can clearly see that when markets sell bonds, they basically force the interest rate to go up on the government debt to compensate investors from the risk of rising inflation. Okay? So what we saw here in the United States, let's have a look at the situation that occurred in the US because of the inflation expectations that happened in 2021. So as you can clearly see, at the beginning of 2021, the interest rate paid on the US government bond was 0.91%, which you can see on the right-hand side of the chart you can see here, which I'm moving up and down now, 0.91%. And then the US government pumped $1.8 trillion, I think it was, into the US economy when Joe Biden first came into power to try to help people during the pandemic, to give them money to help them spend and not basically lose their jobs, for an example, or go completely broke and poor and to starve. So what happened was, because of this inflation expectation going higher by all that money coming into the market, the bond investors suddenly started to expect inflation to rise. So what we can see here is, if we have a look here, I will show you how markets' expectations for inflation started to rapidly rise because of this money being pumped into the US economy. So as you can clearly see from the beginning of the year, in January, the inflation rate, the expectation for inflation over 5 years was 2%. But then month after month, it kept going higher and higher and higher and higher and higher. So inflation expectations kept moving to the upside. And because inflation kept moving to the upside, the expectations, bondholders who was buying these bonds back in January and only getting 0.91%, as I showed you, now are looking at inflation going higher and saying, well, I don't want these bonds, because why am I going to hold these bonds when it's losing? The interest I'm getting paid on these bonds is losing its purchasing power to inflation. I don't want these bonds. I want to get rid of them. And as I was saying, in this explanation here, as they was dumping the price of bonds, causing the bonds price to go from, say, 10,000 down to 5,000, that interest rate on the bond they first received is now much higher on the rate. Then they're going to sell this bond to a new investor. So the bond price drops and the interest rate rises. And this is why we saw in the US bond yield really pick up quite aggressively from January until the 31st of March, when the bond yield reached its peak at 1.77%, which you can see on the right-hand side over here. So the inflation expectations in the United States caused the bond yield to rise because investors were saying, well, if this inflation is going higher, I don't want to own bonds that I previously bought because it's not paying me enough interest. I want to get rid of it. And this chart here is basically showing you the interest rate, the yield, which just means interest on the government bond, and it pushed the yield higher in the marketplace. So what happened to the dollar, which is really interesting, which I want to show you now. So investors all around the world started to see that the US government bond yield was going higher. Now, remember what I said to you. If you're a pension fund, if you're an insurance company, if you're an investor that really doesn't want to park your money in stocks because it's quite volatile and you to lose money in commodities and cryptocurrencies or trade in Forex, what you could do is, if you're an investor in other countries and you start to see that the interest rate in the United States is now paying you more than the interest rate paid on the bond that your local government is paying in your own country, now investors are going to look at this bond yield in the US as being quite attractive compared to their bond yields in their countries. And now you're going to start to see investors from countries that have low bond yields start to take their money out of their country and park it in countries that have higher bond yields because, again, they want to get paid more interest on their money and they don't want to buy stocks. They don't want to take risks. So they're going to look to park their money in a safe place. So Japan, the Japanese government is pinning their interest rate on their bonds at near 0%, and the European Central Bank is also pinning the interest rate on government debt at record lows. Why are they doing this? In Europe, you got countries like Italy, you got countries like Greece that have high levels of debt, and the European Central Bank wants to make sure that they can borrow money off investors at low rates of interest, and they don't default on that debt, which can be very dangerous. In Japan, they have low inflation, so they want to be able to let the government keep spending money to try to drive off inflation, but at low rates of interest. So what we saw in this situation, it was as the US bond yield was rising, you had investors in Europe, investors in Japan looking at the rising bond yield in the United States as being very attractive. And you're going to start to see how the bond yields can start to really drive up trade ideas in the currency markets because the money that wants to be parked in safe places starts to flow into these opportunities. So what did we see? Remember what I showed you guys? We saw the bond yields in the United States from the beginning of it shoot up until the 31st of March, as we can clearly see here. What did we see when we look at, for an example, the US dollar against the Swiss franc in the currency markets? You saw from the beginning of the year, from January, the dollar shoot up in value against the Swiss franc until what date? The 31st of March. And then the US bond yield started to decline because the markets were listening to the Federal Reserve saying that the inflation is only temporary because of the reopening of the economy, and the bond yield then started to decline for the 31st of March. And since then, the dollar hasn't been able to make any new highs against the Swiss franc since the 31st, and the dollar then started to decline. Okay, so what I'm showing you is basically when interest rates in one country start to become very attractive, they start to attract money into that country from other countries that can now attain a higher interest rate of these government bonds compared to their own government bonds. So money was going out to Switzerland and into the United States, for an example. I give you another really good example. Australia. We saw the Australian bond yield again shoot up from early January, and then it reached its peak on the 26th of February. And again, investors in Japan was seeing that the bond yield in Australia was also shooting up. And what happened to the Aussie dollar against the Japanese yen? From the beginning of the year, it was shooting up until, again, around the same period where the bond yield didn't go higher anymore in Australia. So you can clearly see here, on the 20th of February is when the bond yield reaches peak. And there's no surprise that once it reaches peak, the Aussie dollar hasn't been able to go any higher against the Japanese yen because investors in Japan at that time were pumping their money into Australia because in Japan, the interest rates were very, very low. But in Australia, at one point, there was 1.96%, so much higher than Japan. Now that becomes a very attractive place to park their money. So investors in Japan started to sell the Japanese yen, buy the Aussie dollar, and that was pushing up the Aussie dollar against the Japanese yen until the bond yield reaches peak. So what I want to show you guys is that when you really understand this, you can then start to see how bond yields really do drive the currency market. So here is an example. This is the European bond yield, and this is the US bond yield. The Euro USD exchange rate Obviously, euro is the base currency, so we take the European bond yield and then we minus the US bond yield from this, and we get the difference. If it's negative, that means the US has a higher bond yield. If it is positive, that means Europe has a higher bond yield. And then we have the Euro USD. And what can we see? Since the beginning of this chart in 2011, the US has had a stronger interest rate than Europe. And what do you see? Euro USD following the bond yield differential down very nicely. And even when the bond yield then starts to go in favor of the euro, what happens? The euro strengthens against the US dollar until the bond yield starts to turn lower again, and then the dollar starts to strengthen again against the euro. Because remember, investors in Europe are looking at the interest rate differentials and thinking to themselves, well, let me put my money in the US and get a higher interest rate. And again, look guys, you can see when the interest rate differential is going higher, the dollar's getting stronger. Sorry, the euro is getting stronger against the dollar as the interest rate differential is going in favor of the euro. And then as soon as the US interest rate then starts to strengthen again over the European bond yield, what happens? The currency turns over and starts to sell off in favor of the US dollar. They literally move hand in hand. US dollar, Japanese yen, exactly the same situation. We can see here the US interest rate is going up in favor compared to Japan. The dollar gets stronger against the Japanese yen. When the bond yield starts to decline, the US dollar declines against the Japanese yen. When the bond yield starts to expand again and go higher, the US dollar strengthens against the Japanese yen. They literally move hand in hand. You could see the same situation for the US bond yield against the Swedish bond yield, exactly the same. Look, guys, they literally move along with each other. Now you're seeing how the markets trade. This is Euro, Norwegian krona, same thing. The differential drives the currency markets. And then again, here you got US dollar, Swiss franc. Look how beautiful the correlation is between the two. When the US bond yield is no longer getting stronger against the Swiss bond yield, US dollar weakens against the Swedish krona. As soon as the US dollar bond yield starts to get stronger, the dollar starts to get stronger against the Swiss franc. So this is giving examples of the US bond yields against other countries' currencies. You could look at the Japanese yen against the New Zealand dollar. Same situation, guys, plays out. Norwegian krona. Look how beautiful that is against the Japanese yen. Canadian dollar against the Japanese yen. Russian ruble against the Japanese yen. Aussie dollar against the Japanese yen. So what you're seeing is, guys, now you're starting to understand how we use the spreadsheet the professional way. You're seeing why we look at the expectations of inflation. Where is inflation now? And then what's happening with the bond yields based on what the markets are expecting and what's happening now. And even if the central bank is not raising interest rates right now, because the bond yield could be going higher, it could be giving you really good trade ideas. I made really good money trading Euro USD for this exact same reason, and I gave these trades to all my members, and they all made a really handsome profit. We sold Euro USD when the US interest rate was going higher against the euro. Against Europe, we bought the dollar against the yen, we bought the dollar against the Swiss franc, and we made money off these trades. And it was all based on inflation expectations rising higher. So I knew immediately, okay, I know investors in Europe, in Japan, in Switzerland, they're obviously going to put their money in the United States because they need a higher interest rate than the governments that they're issuing bonds in their own domestic countries, because the bond yield in Japan is so low, and so are bond yields across Europe. They're going to have to put the money somewhere else, and you start to see how the money flows into the US from Europe, from Japan, from Switzerland, for an example. So you're really now seeing, guys, the professional market using the bond yields and understanding how we can really get trade ideas when we're trading the currency markets. You can even look at the pound against the Swiss franc, same situation. Look at the euro against the pound, exactly the same situation. The pound against the US dollar, very similar situation. Look, they literally follow each other. Pound against the Japanese yen, beautiful correlation. Pound Swedish krona, same situation. Pound Swiss franc, same situation. So that's how we use this spreadsheet, guys. What we're doing is we are using, as I was just touching on, guys, we're using the expected inflation rate to get an idea as to what's going to be happening in the current level of inflation every single month. And then we're looking at the bond market very, very closely to see if they're going to be pushing interest rates higher, because if inflation is going higher, they're going to push interest rates higher, for an example. And we know that's going to cause the currency to strengthen. On the flip side, if these inflation expectations start to go lower, then investors are not going to have to demand a higher interest rate. And if these bond yields start to fall, then we know that we could sell the currency, because the currency will be in lesser demand, because we're expecting this inflation to start to come lower based on what the expected rate of inflation is in the markets. So guys, I hope that makes a lot of sense. And I've talked about oil prices because that's really important for giving inflation expectations. And we're just building out this fundamental idea, guys, of how we generate trade ideas that professional way before we look at technicals, before we look at risk management, before we look at any other indicators on the charts. We need to get our fundamental trade ideas right first so we can trade correctly and make a profit. Thank you for watching. Let's look at oil prices.